Hey everyone, thank you for tuning in. Today is Monday, September the 22nd. We have about 22 minutes before cash closes, and I want to bring up IONQ. There's some interesting activity going on here today. This column that I have highlighted is the daily volume, and note that for the October 17th expiry, there's very light volume for the in-the-money calls, very light volume near the at-the-money strike, and then all of a sudden at the 100 strike, the 100 call, it's deeply out of the money. They have 17, volume today is 17, a little more than 17,000. This should actually be printing more. I think it's closer to 18 or 19. But anyway, 18, 19,000 volume at the 100 strike, October 17th expiry, and the open interest was less than 200. So there's suddenly been an explosion of activity at the 100 call, October 17th again, expiry. If we take a quick look at, I don't need this, if we take a quick look at a chart for this particular call, we will see that, what do I have here, 30 minutes, okay, that's fine. So early this morning, this call was trading for under $1.50. The low was $1.35, and then all of a sudden it got up to above a touch above 260 earlier today. So 259 looks like 259, 260. So this call, not only has it had quite a bit of activity volume-wise, but it's also that activity is also reflected via the price of this particular call. One more thing I want to mention that's also quite interesting to me is let's look at the roughly at the money strike. So let's go with we can go with the 75. This should work just fine. If we look at the vertical spread here, the 75.70 put, well, let's use the ask price. So this is 10.05 to buy the 75, and it's going to be 7.15 to sell the 70 puts. So it's roughly $2.90, almost $3. So this is basically saying there's about a 65% chance, 64% chance that at expiration the market's going to close in between these strikes, which would be 72.5. All right. So a little more than a 60% chance because we're getting more than, we're paying more than 1.5 to 1. If we look at the call vertical, buying the 75 for 7.35, and we're selling the 80. So this is going to be roughly $1.70-ish, $1.90, let's say. Let's call, oh, no, $1.70. So $1.70 for this $5 vertical, call vertical. So what that's basically saying is for your $1.70, you're getting $3.30. Pay $1.70 and you get $1.30 or $3.30. I'm sorry. So if you think about what the vertical spreads are saying, the vertical spreads are basically saying the market is heavily favored to close lower, the 72.5 strike, rather than the 77.5. And the 77.5 is basically mid-distance between 75 and 80. So because vol is so jacked up in these out-of-the-money calls, the call spreads are very cheap. So it's very cheap to buy these call spreads relative to the corresponding vertical put spreads. Call spreads are cheap. Call premium is jacked. So if you're the kind of dude who wants to sell these calls, you're going to get. Let's say you want to sell the 100 call, which is the very active one here today. All right. If you sell the ask, you're getting 127 IV for that, and the bid is 126.7. So you're getting quite a bit. Let's say this is 25 away from the at the money strike, 127 IV versus if we go to the 50, 25 away from the center. You are talking about a touch under 120 IV. So again, very, very interesting activity here, and it's also kind of cool to see what the vertical spreads are saying about the market. And quickly, the Cliff Notes version of the vertical spreads is they are saying, the put spreads are saying that yes, the market is more likely to go down than to go up, but because it can still, the market's saying it can go up a lot, this IV is driving the price of these calls up, and it's making the call spreads relative to equivalent put spreads cheap. It's making them cheap, so it's very, very interesting. Okay, that's going to be it for this one. Good luck, guys, and I will catch you later.